Well, hello, everybody. Thank you for joining us. I hope you're not hearing me as echoey as I sound to myself, but thank you for joining us. If you're here for a quarterly update on REIT performance, you're in the right place and you're with the right people, I might add, including myself. I'm Mike Consol, editor of Real Assets Advisor magazine, one of 6 titles published by Institutional Real Estate Incorporated, which is co-producing this webinar as we do every quarter, along with Nareit, the National Association of Real Estate Investment Trusts. Nareit is being represented by John Worth, Executive Vice President of Research and Investor Outreach for the organization. Also joining the discussion is Geoffrey Dybas. He is Executive Managing Director and Head of Global Real Estate and Senior Portfolio Manager at Duff Phelps. Now, to all of you who are joining us, as we do every quarter, we invite your questions in writing. We will get to those questions as much as possible in real time. Also, we're going to be recording this webinar. We're recording it right now. And the slides that you will see, all of the images and audio, will be sent to you. A link will be sent to everybody who registered for this webinar, and that will be published on the IREI and Real Assets Advisor website, so you can find it there. Also look for that link. John Worth and Geoffrey Dybas, welcome to both of you.
Thanks, Mike, and nice to be here.
Mike, it's an honor to be with both of you. Fortuitous time to be sitting around the Nareit virtual picnic table. Thank you.
There you go. John, as always, we begin by having you give us a quarterly summary on REIT performance. Obviously, what we're talking about now is a fourth quarter 2024. How did we end the year?
Yeah, I'll jump in, and we ended the year definitely on a down note for REITs. As you can see on the graph, REITs fell 8.2% in the fourth quarter, and that was really driven primarily by losses during December. October and November were pretty much balanced each other out. One was up about 3%, one was down about 3%. Then we saw the index fall about 8% in December, and that was really driven by an interest rate story, I think. So the graph I'm showing now shows you the sharp or strong negative correlation that we've seen really since the end of 2021 between the 10-year Treasury in light blue and the REIT index, the FTSE Nareit All Equity REIT Index in dark blue. And you could see there at the as we go to the end of 2024, you can see that starting in mid-September, we saw the 10-year Treasury rise more than 90 basis points, up about 96 basis points, and we saw REITs fall off more than 9% during that period, after having appreciated significantly from really mid-year through September as the 10-year Treasury receded, and as I'm sure we'll discuss, that's been a bit of the case so far into this year. As we look across the sectors, we could see that again we had like last year, we had a lot of diffusion across the sectors, and we're showing the fourth quarter on the left-hand side, full year results on the right-hand side. As you can see, just 2 sectors positive for the fourth quarter: data centers and lodging and resorts, the hotel sector. The worst performing sectors, those that really kind of took it on the chin in the fourth quarter: telecommunication, cell phone towers, self-storage, industrial, and timberland, all had meaningful declines in the fourth quarter. And for industrial and timberland and telecom, that really flowed over to being the 3 sectors that were at the bottom of the table for full year 2024. When we look at the top of the table for full year 2024, we could see specialty was the best performing with appreciation of positive 36%, data centers up 25%, healthcare up 24%, and perhaps surprising to some, office up 21%, showing a strong rebound from prior year weakness. Last thing I'll note, just because I think we'll talk about it a bit. When we look to capital markets, we could see that REIT issuance stepped up in capital markets in 2024. We actually saw total issuance of about 87 billion in 2024, up from 61 billion in 2023. And we saw unsecured debt issuances nearly double from 2023 as capital markets have really been open for REITs when they've chosen to issue. So with that, let me stop sharing. We can get into the discussion.
But Jeff, let me ask you, what do you think of the numbers you're seeing? In particular, if you could address industrial. We've been talking about industrial as the property type of the year. That and multifamily has been performing so well for years running. Industrial is down quite a bit. If you could address that, but then also everything else you're looking at there.
Absolutely, Mike. So a few things just to build on John's great comments. In December, certainly all property sectors were in the red. And let's just review what was going on. We had the third, Fed cut of the year, effectively. We, 50 and a couple 25s. But the verbal message from Chair Powell certainly came across as more hawkish. He astutely, along with the Fed, realized they should create some cushion for themselves in their verbal message and the takeaways and the dot plots. And it's not dissimilar to, often as we'll see in the coming weeks, the publicly traded management teams give a little cushion in their guidance. Some of them love to beat and raise throughout the year, and don't be surprised if we see a little bit of a cushion there. From a standpoint of, as you hit on, industrial and multifamily, in terms of each how they traded. Industrial for a bulk of the year was, facing questions on speed of decisions relative to the past, and where some of the decision makers with the upcoming uncertainties around the election, some of the economy deferring some decisions. Industrial's also been going through a period where supply had crept up a little bit, and that's coming in now. Same with multifamily. So both sectors have that in common, that they've gone through a period where supply was rising a bit. And now as we look forward into 25 and 26 and even 27, we see a much more favorable supply demand picture, for those two sectors, if you will. So let me pause for follow-up.
So John, based on the numbers that you showed us, the disappointing fourth quarter, I mean, we see the sharp decline or December sell-off, but what were the driving forces behind those numbers? Was it simply year-end timing? Was that an issue, or is there something deeper going on?
Yeah, I think as Jeff noted, I think it really was very much Fed rate driven in terms of operating performance. Operating performance has slowed a bit, but has been, I think, strong enough and not enough to, and there wasn't any announcement effect to cause such a sharp sell-off. I think that one of the things that we've seen is that, over the last couple of years, we've had this strong negative correlation with where the 10-year Treasury is and REIT performance. And it's important to keep in mind that that's not always the case. We've gone through periods where REITs are more and less negatively and sometimes even positively correlated with the 10-year Treasury, kind of depending on where we are in the monetary policy cycle. So, for example, if you go back and look at the last 20 plus years, and look at 12-month periods, what you see is that REITs are positive, have positive returns in about 75% of those cases when the 10-year Treasury rises. And in those are cases where the 10-year Treasury is rising on stronger growth, and REITs are reflecting that. Here we're still in this period of monetary policy adjustment, and I think one of the things that we're looking forward to in 2025 is kind of getting to the end of this monetary policy adjustment cycle and REIT returns being a little less macro driven on a day-to-day and month-to-month basis.
Mike, if I could build on John's comments there quickly, and the rate increases, the speed and magnitude of the change in rates is really critical, to this topic. Just as we saw from, the summer forward, the significant movement of the 10-year, which John was highlighting, in the past, such as in 22, when we saw the Fed increasing at a very rapid clip in terms of speed and magnitude, it was just too much for broader equities as well as the publicly traded real estate market to absorb. But you can think back in time to, June of '04 through June of '06, a unique period of time. The Fed increased 17 times in a row, and during that period, publicly traded REITs outperformed the S&P 500. So it just speaks to another window of time in my tenure to support John's comments.
So Jeff, 2024 saw the largest initial public offering in REIT history, that being Lineage Logistics. It raised $5.1 billion in its July 2024 IPO. Do you have any forecasts as to what kind of IPO activity, or for that matter, follow-on or secondary public offering activity we're likely to see in 2025?
Well, let's break this down into a few factors. One is, how is the market trading right now, and would the bankers want to bring out, a new company? At the current time, we view the market in terms of pricing after the pullback we've had as compelling. So if we're in the banker's shoes, we're likely to defer that IPO until we have better price action in the market. Another factor would be, for the bankers who could review last year and say, how did they do? Well, from that IPO you mentioned through yesterday, it was effectively trading down close to 25% versus the all equity REITs benchmark. So, the bankers might have to visit office hours for a little bit more help and, get some professorial help on how they want to structure that deal. Do they want to have better alignment of interest? Do they want to have better pricing? That company management in terms of its message in the IPO process as well. So, look, last spring, we were a year after we lost the great Sam Zell, and I want to make sure we as the REITsters, myself and that specifically along with my peers, do our job in reinforcing what we want to see in companies when they come out, and are not shy at putting a little pressure on the bankers in their delivery. From the
John, do you
secondary
concur, or do you have
perspective,
a different
yeah,
take on that?
just one quick point though on the secondary side, for both debt and equity. On the debt side, we find in the listed REIT space things very attractive in terms of the spread at which they can issue today versus the treasury market, the breadth and depth of demand, and then frankly, in terms of how skilled, and this is something that's unique, I think, from the listed real estate investor versus the private, they are at de-risking the debt maturities over time and taking advantage of what the unsecured bond market offers. And so when we look at, for example, at 25 or even 26, we're looking at debt maturities in aggregate of, let's say, 9%, per year, which is much more attractive at de-risking debt maturities in the capital stack than one can have in the private market. Now, as it relates to the equities and the secondaries and at the market offerings, those are great vehicles to have at the disposal for the publicly traded companies, and we think they'll take advantage of that at appropriate times, just as they will look at stock buybacks when it's prudent. So, thank you.
John, anything to add to that? Do you concur?
Yeah, I just on the debt issuance, I just reinforce Jeff's point that debt markets are wide open at a time when bank financing is still stressed for commercial real estate. Things are opening up, I think, in the CMBS market a bit, depending on the sector. But with REITs, we've really seen that debt markets are open. They're getting nice spreads. I do think that with the rise in rates over the last month and a half, we may see a bit of a pullback in Q1 issuance. REITs have been kind of, when you look at their month-to-month issuance, you see they've been very strategic. They're not really being forced to the market because they tend to have pretty conservative, well-structured balance sheets with a nice weighted average term to maturity. So they've been able to be selective and go in and out of the market in sort of at a time and place of their choosing in a way. So you'd expect with rates up, you may see a pause in Q1, but I think later in the year we're likely to see more issuance.
So John, Nareit in December published a 2025 outlook for the new year. What were some of the highlights, lowlights from that? What kind of predictions were made? What can you tell us about that outlook?
Yeah, so we really made three broad points. The first was that for REITs specifically in 2025, our view is that REITs are going to find accretive growth opportunities as we see transactions tick up in the commercial real estate space, using the ability to coming into the market as low levered players with access, as we're talking about, to both equity and debt financing. Well, we've got maybe some other players coming with more leverage, less able to act in a period of relatively higher interest rates. that may give REITs a real comparative advantage as in terms of executing transactions and finding these accretive opportunities, as we're seeing kind of public and private valuations start to come back together after a lengthy period of being in essentially equilibrium. So we view that as a real positive for REITs, that there may be a real growth opportunity that could kick off a period of very strong performance. More broadly, we kind of looked around the world at global performance, and one of the things we just kind of noted is that when you think about the sort of the broad trends, we call them mega trends in the piece, that we think are going to define real estate, the shape of real estate really over the next decade. The ability to have scale, specialization within property sector, innovation, and sustainability, that U.S. REITs are really leaders in three of those four. When you look across the globe, really the specialization, scale, and innovation. And then there's a third part of the outlook where we really looked at some of the innovative ways we're seeing institutional investors use REITs in their real estate portfolios, both in terms of getting access to geographies they may not have through a private portfolio, getting access to property sectors they might not have access to, and using the REITs opportunistically when markets are out of equilibrium to really try to work between their public and private portfolios.
Jeff, REITs have now lagged the S&P 500 for 3 consecutive years, which I find interesting because, in part because one of the criticisms of REITs is that they tend to behave like every other equity that doesn't have to do with the fundamentals of the real estate contained within, but they just move in tandem. Well, that's not been the case for the last few years. Again, they've lagged the S&P 500 3 straight years. Have you ever seen REITs as measured by the all equity REITs index run behind the stock market for that many years?
Mike, we actually have. In fact, interestingly enough, it was after the tech and telecom run or era of 97, 98, and 99. And so during that period in each year, REITs did lag the broader equity markets measured by the S&P 500. And tech was leading. And there's some similarities to that as we can all appreciate, given what we've seen, in 22, 23, and 24. And so one could ask, okay, after 97, 98, 99, what happened? Well, on an individual yearly basis, 2000 through 2006, REITs outperformed, as measured by the All Equity REITs Index, the S&P 500 each year for 7 straight years. And then they went on a period of time where the S&P outperformed for a couple. Then, we look at that was 07, 08, and then, 09 through 12, REITs outperformed for 4 years. And then it was a year, and then it was 2 back and forth. And that's how it evolved. But from our standpoint, we look at where was, for example, the environment set back then. It was set for REITs to outperform, and we think it's compelling once again today.
So, what does history teach us then, Jeff? You run into a losing streak like that. When REITs do bounce back, how strongly or weakly have they rebounded? I mean, what can we anticipate?
Well, I think, in terms of return building blocks, it's really the heart of the question. Today, when we look at things and say, where is the dividend yield in the space? Straightforward, let's say it's, roughly 4%. And then from a standpoint of on cash flow growth, if we're looking at cash flow growth accelerating, which we are here at Duff Phelps, to, let's say 5%, putting those both together, valuation aside, those building blocks lead us to a 9% plus or minus range. Now, certainly valuation expansion can enhance that, take us into double-digit territory. If we have valuation compression, it could bring that in. And so as we look forward, we do see an environment where, as I mentioned before, we look at from a standpoint of the left side of the balance sheet, the assets, and the right side of the balance sheet, that capital stack. The publicly traded companies, the listed REITs, have done a fantastic job of lowering leverage, diversifying the debt capital stack, by duration, by year, in terms of maturities. And we think, they've dealt with much of the refinancing headwinds that one could face. Now, there's some more to come, naturally, over the next year to 2 to 3. as debt matures. But relative to their private counterparts, we think they're in a much stronger position. And, I'd be remiss if I didn't highlight as well that, the access for some of the leaders on a global basis that are listed in the U.S., John referred to some of the areas, they've had tremendous and continue tremendous access to issuing debt overseas at much cheaper rates often. And that can be a natural hedge then for, the revenue they're earning, whether it's in euros, whether it's in yen. So when we think about a euro per square meter lease or a yen per subo or a pound per square foot, those assets are often very well hedged with cheaper debt, and it actually is a nice natural hedge. Whereas on a broader equity market basis, for example, I think about earnings season for the S&P 500, we're likely to hear management teams talk more about the headwind of the dollar than we are in the REIT space. Naturally, for anyone looking at REITs, your buy side, your sell side, you're looking at your estimates today, probably want to give yourself a little bit of cushion for somebody who's got healthy, ex-US exposure. But we've got some great positives the way it's set up for us versus the broader equity market.
So, John, let me read you a question from our audience. It goes like this: is the decline in industrial more related to its lower yields? Where are the yields today for industrial versus residential and other sectors?
I think, as Jeff alluded to earlier, I think the real issue with industrial, kind of the pullback in industrial, has really been this concern about supply-demand conditions in that market. If we think back a couple of years, we had deliveries in industrial and in apartments that were at all-time highs, really, literally off the charts. If you sort of looked at if you plotted that out, so that has resulted in a slowdown in rents, or at least a slowing of rent growth in both those sectors. Although, again, coming off of all-time highs in terms of rent growth in those sectors. So, I really think it's the supply-demand conditions that are driving everything in those markets. And as we've seen, so after a period of great supply and slowdown in returns, we've seen that supply spigot, especially with higher interest rates, really slow down. So I think we're in a period of really kind of digesting that supply.
So, John, let me stick with you on this. Nareit, you've got an active manager tracker. It aggregates the positions in more than 25 large, dedicated, active U.S. REIT strategies. Talk about those positions. How have they been changing, if at all?
Yeah, we actually saw quite a bit of change over the first 3 quarters of the year. We're pulling in the fourth quarter data right now. That comes in after the year end. But it was very interesting. What we saw was when you looked at the changes in active portfolios taken in aggregate, we saw that the on a year-on-year basis, the largest moves were in telecom, as we saw active managers moving into the telecom sector, buying the cell tower REIT stocks, moving into specialty, and moving into healthcare, with which we saw a large step up in all 3 of those. On the other side, we saw them moving away from residential, industrial, and retail. However, if you look at the net position, what you see is that residential still ends up being one of the sectors that has the largest overweight. Whereas if you compare the active manager positions to the index weight, residential is at 120% of its index weight in active positions. That's up there with telecom, up at about 123%, data centers at 130, and healthcare at 115. Whereas we see the underweights in office and lodging resorts in particular. So we saw quite a bit of movement over the year, and in particular, I think some of it really relates to where we're seeing 2025 sort of demand growth, and where we've seen supply come online in 2024.
Okay, Jeff, there is an argument that listed REITs provide diversification, inflation hedging, and capital appreciation relative to other equities. Now, assuming you concur, make that case.
Sure. I do concur. And we think about, in terms of the underlying investments of listed REITs, what are they? Real assets, physical assets. And so we know when inflation rises, hard costs, soft costs, the cost of construction, those hard costs could be, steel, concrete, timber, from a soft cost, the general contractor costs, architectural costs, et cetera. They all rise. And the replacement cost then lifts. And so you have a compelling argument as you look at the balance sheet and say, okay, the value of the replacement cost continues to go up. And then from a cash flow perspective, fortunately, we are in an environment right now where in the U.S. the economy is pretty solid. Certainly, there has been a strong support from fiscal policy on top of the battle with the Fed on monetary policy, but we see cash flow growth lifting. And how does this happen? Higher occupancy leads to higher rental rates. It helps drive higher net operating income. And so rising replacement costs, a rising cash flow, and then the shorter the lease duration is, the more frequently they can reprice the leases in an environment of strength. And so you can capture that pricing power and environmental demand more frequently. If it's a longer lease and the lease is actually a bumps built in, Mike, that's another way. And so those are ways relative to one's ability to hedge in an inflationary environment. And then I referred to the debt capital stack before. Certainly, when you can actually, in an environment, as I alluded to before, 04 through 05 through 06, for example, when the Fed was hiking, it was doing so at such a reasonable pace that the actual benefit from the assets, from the rising replacement costs, more than offset the creep in cost of debt and cost of capital. And on top of it, just to circle back, besides the benefits of inflation hedging, the diversification, we have the beautiful, I would say, liquidity, which, just to remind everyone, we can think about the listed REITs, much like visualize that beautiful home in Tuscany. What's missing in your head? Gates, no gates. You just walk right up. And that's the beauty of our liquidity. Every day we're open, every day we trade. And that's one of the key beauties here. And then to round it out, the diversification we have, the governance we have, which is truly industry leading. John touches on this very often. We set ourselves apart relative to the potential conflicts of interest that sometimes run into some of the private real estate investing.
Gotcha. Another question from our audience, John Worth, one of our attendees is saying, what U.S. REITs stack well in terms of healthy ex-U.S. exposure? Am I understanding that right, John? Ex-U.S. exposure meaning outside the United States?
I think that's the question, and I'll ask Jeff to jump in on this as well. I mean, I would say in general, the large scale, especially some of the new property sectors, data centers, cell phone towers, of course, logistics, is where you tend to see the largest non-U.S. exposures among U.S. REITs. Jeff, I don't know if you want to
Yeah,
join
no, I
in
would
on that.
exactly. I would echo that. I mean, the points being, in data centers, and Equinix, a Digital Realty, certainly with their global footprint and leadership, they absolutely have, amassed, tremendous, property portfolio outside the U.S. And, they're meeting the demands of their global tenant base, with leases in multiple locations, and that clearly we could say for industrial Prologis has been doing that for years. So from a standpoint of data centers, we see it, in the telecom REITs or the cell towers. For some of the companies, we certainly see it. Over time, it's been episodic. Public Storage has had, investments on an ex-US basis through its original acquisition of SureGuard, and certainly that, ultimately spun out, it's publicly traded, and they continue on with a position, underneath that. And then when we look at, some of the select healthcare names have had exposure. Certainly Simon in the regional mall space over time has had good, ex-US exposure. And so it varies, quite a bit. But certainly, when we think about one of the benefits that John was indirectly, getting to is that in the U.S., the non-core property sector growth, which has occurred over time, includes so many key leaders, some of which I rattled off, that have substantial portfolios on an ex-US basis that are really beneficial to the underlying shareholders.
Is it fair to say certain property types travel better than others? I mean, a data center anywhere else in the world is like a data center in the US, or a cell tower, or maybe even an office building. Or are certain property types distinctly different in foreign countries and don't travel as well?
I would say it's not necessarily a case of travel. It's more about how acute the benefits of scale are. So, for example, if you think about the client for a data center, it would be great to own one data center. I'd love to own one. It would be fantastic. But if you want to go to the largest global users of data centers, they want a network. The same is true in cell phone towers. I think that one of the things we think is interesting about scale is that we're starting to see that really come through some other property sectors. I think retail, grocery anchored retail is a great example. We're starting to see some of the REITs in that space get really quite large. In triple net, we've got some very large triple net REITs. And so we're seeing this ability of REITs because of their corporate structure, because they're permanently lived vehicles. They have the ability to grow quite large. They have the ability to offer that scale to tenants. And I think it's not so much about does it travel, it's really about how acute the benefits are of being able to deliver that network of properties that can help a client really achieve what they need to achieve with their real estate strategy.
Jeff, I've got a question for you here. From one of our audience members says, what are your thoughts on Canadian REITs? Does Duff Phelps own some Canadian REITs, invested in some Canadian REITs? Are you as comfortable in Canada or Australia as you are in the United States?
We do. Certainly I'm ahead of a global team, and we do invest in the names in Canada and names in Australia. From a standpoint, just some quick points on Canada, not dissimilar to a little bit of the music we recapped for the U.S. Canada had a great performance-wise for the stocks, a great third quarter. After that, there's significant consolidation we've seen. Certainly from a governmental perspective, some change in, governmental leadership. We've had, changes in, policy as related to immigration. But from our perspective, as we look at certain names in Canada, we think there's compelling opportunity. They've been, put under too much pressure. And so, we echo that theme specifically in Canada without, talking up our book or going into names. I'll stay away from that. And then in terms of Australia, certainly, we've been investing in Australia just like Canada for many, many years. And we see opportunities there. Some of the opportunities in Australia we see could be in existing core sectors as well as in non-core. And yet there are some names in Australia, we'll look to avoid specifically. And so, hopefully that gives you some added color, Mike.
Mm-hmm. So John Worth, you've been predicting, drum roll, predicting that REITs will become acquisitive as the property transaction market becomes more active. I think that's a pretty safe prediction, but is there any evidence that trend has begun?
We did see some acquisitions in the fourth quarter, but I still think in terms of broader markets, those commercial real estate transactions, they're loosening up. We're starting to see them, but I would say we haven't really seen the type of activity that we think we'd like to see and that we think we'll see later in the year. I think a big question mark in that, and it's certainly one we talked about in our outlook, is what are the implications for that transactions activity of interest rates moving back up as they certainly have over the last couple of months. So I think it's we may see that rebound in transaction activity that may get moved back to a little bit later in the year than we would have hoped for and we would have expected back in October and November, just because of the run up in rates, which I can occasionally make deals harder to pencil out, and so we end up seeing less transactions take place. But we really do think that REITs are, because they're coming in with about 30% leverage, about 80% of their debt unsecured, about 91% of their debt is currently fixed rate, and with a weighted average term to maturity of about 6.5 years, that really provides an ability to not just manage through a period of higher interest rates, but to really be successful in a period of higher interest rates. And so we think as those transactions markets open up and we see more properties maybe held in private portfolios getting marked closer to reality, that we're certainly likely to see REITs being more likely to be acquirers than disposers of properties.
In acquiring, what property types do you think they're going to be especially acquisitive about?
I think it's I think it's going to be across the board, frankly. When we at venues like REIT Week and REIT World, our large investor conferences, certainly what we're hearing is really across the board. CEOs and CFOs are feeling like there are opportunities out there if transactions will open up. So I'm not sure it's necessarily property sector driven. I think we're seeing that confidence across the board.
Geoff Dybas, audience question. In terms of inflows of non-traditional REIT managers, are there any themes that differ from prior cycles leading to the price action as hedge fund managers are using REITs as a way to play rates?
Yeah, in terms of, let's say, price action and thinking about it, for forces that are at work, certainly whether it's prop desks, hedge funds, it's quantitative players, it's those looking at factors. We often can break down from an equity attribution perspective, the factors that are moving the stocks, momentum perspective. All these, are at work along with many others. And so, that is something we keep in mind. And, part of that actually leads to, the opportunity. When we think about, John's highlighting the move in rates, from the lowest yield in the 10-year in September to right now, it's 120 bips up. That's a material move, and it's in a short period of time. So when we talk about magnitude and frequency, it checks both the box that can give a more compelling entry point or one to add to one's allocation today listed real estate. So my fellow REITsters, when we come on these calls in terms of participating in the virtual picnic table for Nareit, not everyone gets a window like I do, where bonds have sold off, rates have backed up, in this case 120 bips in the time period I mentioned, and the price actions then come in. So that to us is a more favorable one. But we're not likely to see these forces at work on price action go away, just as they can be there to sometimes push things down to create opportunities. They can also turn and move and help push things up too. So, we don't see any of those forces of price action really changing over time. And it's an opportunity for us as an active manager to drive alpha through security selection and take advantage of it.
John Worth, one of our audience members, has invoked the devastating Los Angeles County fires. I mean, besides wiping out thousands of really expensive homes, a lot of businesses got burned down as well. So the questioner is asking really what the impact of that's going to be. I don't know if you know of specific REITs that have sustained losses. Would something like this affect the broader REIT market? What do you think?
Yeah, and of course, it's a terrible tragedy. I'm sure we all know people who have been affected, and it's really I lived in LA for over 5 years, and so it's really terrible and a challenging environment that's ongoing. I would say in terms of the impact on REITs, I don't think there's going to be any meaningful impact directly on REITs. REITs tend to have well-diversified portfolios geographically. I know the questioner asked a little bit about, insurance markets, and I do think that's going to be a real challenge for California. Obviously, this is going to be in the homeowner market, which has been, challenged for some time in California. This is going to, I think, further challenge the finances of California's state system. But you do, of course, you think that as there's a reassessment of risk, that could certainly spill over to commercial markets. I think that's going to impact commercial real estate, in Southern California, writ large, REIT and non-REIT, and certainly coming on the heels of, a lot of very meaningful increases in insurance rates across the country, but particularly in risk areas. I think this will exacerbate that issue.
Now, and Mike, if I could build on John's answer, I think first and foremost, we all think of the firefighters, the first responders, police who are all helping out, putting their lives at risk, in this tragic situation. And we can all think about our own respective efforts to support them in different not-for-profits, just like I do for example, the 100 Club of Illinois, which started out as a 100 Club of Chicago. Specifically when we've seen environmentally driven tragedies over the time period, we've seen a clear increase in demand for where people need to go in terms of available residential capacity, vacancy that may exist, whether it's in apartments, whether it's in other types of property, in terms of the goods for the rebuilding of the effort, and whether it's industrial, whether it's self-storage, there's an immediate need, for that rebuilding effort and to shift goods for people to different locations. So we can see, industrial demand pick up in the greater LA tied to this. We could see self-storage, pick up, and we could see clearly, for those with available residential capacity, to pick up. Those are quickly, some of the areas on a not just a short-term basis, because this rebuild will go on for some period of time, but many of those property sectors, some of the assets clearly can benefit for the intermediate period. So if they do have capacity, if they do have vacancy, some of that may be called upon and put to use, fairly short order.
Yeah, California Governor Gavin Newsom is saying it's going to take what, I forget what the time frame is, but just to clear out all the wreckage is going to take many months before they can even start to rebuild. So it's a bad situation. Another question from our audience. A few years back, investors were very negative on USA shopping malls, and that had a negative impact on European REITs with exposure to shopping malls in Europe. And it seems a similar situation is happening today with office space. John Worth, would you say that it's akin to the office situations, akin to shopping malls, or what are the similarities or differentiators there?
Well, I think the big similarity between where we are with office and where we were with shopping malls a number of years ago is really that quality ends up being a really key differentiator. If you think about the malls who sort of made it through the valley in a way, and have made it through to the other side, and we had pretty good regional mall performance in 2024. The sector was up 17%, and when you look at statistics like foot traffic and sales, regional malls are really doing quite well. But that's really been the fruit of a lot of labor in terms of CapEx, in terms of repositioning who the tenants are, and it's really been an area where the high quality mall, kind of the best mall in the geography, is successful. And so if you're the owner of that, you could be quite successful. And I think we see an analogy there, or an analog, I guess, to office, where there's been a real premium on quality. High quality office, is leasing out quickly. In cities like New York, there's really not much left in terms of the stock to be leased out. We're even seeing some REITs making announcements about breaking ground on new buildings. So I think there's definitely that parallel between quality between the mall sector and office. I will note that when we think about that performance across geographies, we have seen different performance in office, across U.S., Europe, and Asia, based on very different work patterns. Sort of Europe, perhaps surprisingly, has been less quick to embrace work from home, and Asia has in a lot of Asian cities, people are back 4 days, if not 5 days, back in the office. So it's been a different set of conditions on the demand side.
Mm-hmm. So, Jeff, let me ask you about that situation with malls. While they were dying off, they reinvented themselves, some of them anyway, became lifestyle malls. They turned themselves into destinations, higher caliber dining, entertainment, a strategic tenant mix. Is something like that, do you foresee something like that with office, where office is going to reinvent itself and kind of figure out what is it that we bring to the table that you don't get at home? For the worker at home who says, I'm happier at home. The office offers me nothing. I've got the technology at home. Why do I need to be there? There's a lot of traffic involved and so on. Uh, do you see office owners and purveyors making this effort to reinvent themselves, much as malls did?
Yeah, let's just touch on a couple things first. When we look at the pie today, much like breaking down, let's say, a Thanksgiving pie, office is about 3.6% of the all equity REITs benchmark. Regional malls say are 4.7, and shopping centers, 5.4, just to begin with. Now, in terms of, ability of management teams to garner market share and to deliver what the tenants want, that's clearly at the fingertips of someone who has great assets and strong submarkets, the underlying demand that, John alluded to, whether it's a regional mall, whether it's an office, company and specific office properties. And we have certainly seen, probably in the recent history with an office, an ability to take market share, those publicly traded companies with capital who can cover the work letters, the tenant improvement dollars to pay the brokers, that have the well-located buildings, that, have the amenities that tenants want and seek, and are meeting them, and can give the brokers confidence when they walk a tenant through prospectively, that not only can the tenant improvement dollars be funded and paid, and the brokerage commissions can be paid. Whereas conversely, we have a lot of office buildings that are zombie buildings. I can look in Chicago, in the suburbs, or in the city, and parts of New York have the same thing. Yet other parts of New York, say Penn Station, tremendously growing demand. And so TI can be funded, tenant demand can be met. Quickly, those submarkets find themselves in a shortage of space for particular buildings on particular blocks in New York or other key markets. So whether it's parts of New York, it's around, let's say, Tokyo Station, the Marunouchi district, and in Tokyo, when you think of the key five wards there, when you think about the exact center of Paris, Ile de Paris, there is tremendous demand. Yet, La Défense to the west and Paris, or when we think about, suburban Chicago, suburban New Jersey, different markets, there is a high level of vacancy that's not going to change anytime soon. So it's very building specific, it's very owner specific, it's very much, amenity package specific. So that's key today. And that's part of the reasons why some of the office stocks did so well last year, Mike, is they were delivering what tenants wanted. The market saw that and rewarded them with a greater shareholder price because they continue to see strength in their delivery going forward.
Mm-hmm. Mm-hmm. So, John Worth, I've got a question here from one of our participants. It's the same thing that I was wondering. What explains the significant underperformance of telecom REITs? I mean, cell tower REITs. It's not like we're using our phones or using wireless any less. Why the decline there? Did it just get? I mean, did we have a bubble situation? Did it just get overpriced, and this was a normal adjustment? What's going on?
Yeah, the last couple of years for the telecom REITs have really been a case where the demand drivers for their tenants, essentially the telecom company, the mobile operators, they have just been slow, I would say, and slower than expected to deploy new equipment. In some ways, you could think about we had the 5G rollout, 5G deployment that created a wave of demand. There was an expectation, I think, that we were going to see even more rollout. I would say in some ways, some of the if you think back 3 or 4 years, when you think about some of the ideas of where demand was going to come from in terms of high intensity mobile usage, some of the things people were talking about was, driverless cars, remote activities. Those haven't really come to pass. In some ways, there's been a little bit of a lack of a killer app in terms of something to drive that telecom demand. So obviously, usage is still there. and there's an expectation that we'll see that demand start to grow in 2025. That's one of the reasons why we've seen those upticks in the telecom shares in active manager portfolios. But if you kind of think about, sort of the in comparison to data centers, where sort of the killer app in terms of AI really hit, and you saw that projections of really steep demand growth. That just hasn't been there in telecom for the last couple of years.
Mike, just to build on John's good points, I mean, fortunately, here at Duff Phelps, we're close to a century of covering real asset names. And, I can, along with our members of the team, walk down the hallway and talk to our analysts covering, the carriers. And certainly carrier CapEx, has been light versus expectations, which John was alluding to. We can also walk down the hall and talk to, our analysts covering the utilities and different power providers around the globe, because that is so critical today for the underlying data centers. You can build a data center, but if you can't get, power available and, drive it for the tenant today in a reliable fashion, on top of having great location connectivity and other factors, you're not going to be able to meet their needs. And so, within, the real estate space, these sectors such as telecommunications for cell towers and data centers in particular, it helps to be able to tap into that knowledge just beyond the pure play real estate space to tap into other people who are covering the utilities and covering the telecom names themselves.
So Jeff, I have another question for you that I think at least tangentially answers one of the audience questions. When you examine the balance sheets between listed real estate, publicly traded REITs versus private real estate, talk to any advantages of listed versus private, but also what's the variance right now between listed real estate and private real estate?
Well, a few things. I thought John did a tremendous job of rounding off some of the key stats in terms of the debt capital stack, the debt duration, the maturities that are coming up, the level of floating versus fixed. And all those spoke to, I think, CFOs who, are in the dean's list. They've done a tremendous job, and they took their lessons and went back to office hours after the global financial crisis and decreased floating rate debt further. They extended the debt duration and then taken advantage of it. And, the tapping the unsecured debt market is so key as a strength in doing so versus what the private players can do. And so we know, and, the publicly traded companies that have both secured and unsecured debt will often frequently highlight that, the secured debt maturities come due sooner. You can't go as far in duration. And in the unsecured debt market, you can go out much further. And then historically, there certainly has been, the ability to at times tap into, the green bond market as well, from a standpoint of a slice of underlying fixed income investors as another play. So, we think those are distinctive points. They allow, the publicly traded names to have capital at the ready to put to work, as opposed to having to have specific project or asset financing for a secured mortgage as well.
John, what about any other factors that you would consider positives or complementary with regard to listed real estate to private real estate? I know you're not in the business of touting private real estate. You like the publicly traded variety. But on the other hand, you have nothing against private real estate. What are some of the other positives that you would point to, or maybe differentiators?
Yeah, and I think one of the things that we stress, we talk to a lot of institutional investors at Nareit, and we have REIT in our name, but we don't walk into these meetings and say, hey, you should only use REITs. You should have a 100% REIT strategy. We think that there are great opportunities to have for institutional investors in particular to have really complementary portfolios of REITs and private real estate and use those together. I think one of the great examples, we wrote a case study on this that we published in early 2024. It was a pension fund in Texas that is primarily a private real estate investor, but they understood that REIT and private valuations were out of sync. REITs had priced in higher interest rates, or perhaps even overpriced in higher interest rates. Private funds had yet to start really meaningfully reflect those. They made an opportunistic investment into REITs. beat their index by high double digits, had a great return. We've got lots of case studies showing how plans who maybe don't have access to some of the innovative property sectors, or even within traditional property sectors, don't have access to the geographies that they'd like to have in their portfolios, can use REITs really like a Swiss Army knife in a way to kind of take your real estate portfolio where you want it to go.
The Swiss Army
And John,
knife
I
of
think, that is
investing.
a,
Go ahead.
really good highlight. When we think about on a global basis, I think our global clients, we are very fortunate and honored as we are to be entrusted with capital from any of our clients, all of them. And, one client in particular has a, tremendously large private real estate book. And, we have been able to complement that with a listed portfolio in the non-core property sectors. And we're driving alpha for them in doing so. And, as we typically do, drive it from security selection. Very honored and pleased to have that. And we see more of that coming, down the road in terms of sovereign wealth funds, very large global players who have historically had a very large and significant private portfolio. And they would like to tap into, with greater breadth and depth, the non-core property sectors than often they can with a specific individual private real estate fund allocation. That they may be able to get some access to, data centers. They may be able to get some access to some of the other non-core sectors. But in terms of the breadth and depth of choices and opportunity that we have in the listed space at our fingertips, they truly appreciate that. And I think that growing appreciation will lead to more arguably non-core, strategies and specific listed portfolios that offer that. And that's something we do here at Duff Phelps.
We're running short on time, but before we wrap things up, I want the both of you to talk about what property types you find promising at this stage. And in the case of you, Jeff, where Duff Phelps is placing its chips. John Worth, why don't we start with you, though? What do you see as promising? And then we'll turn to Jeff and see where Duff Phelps is actually, again, placing their chips.
Yeah, I think I'm gonna take an easy one, leave the tough ones for Jeff. But I think healthcare is very interesting. We had a very interesting dynamic where when we think about senior housing, basically in starting early in 2020 with COVID, basically nobody was putting in a shovel in the ground to start a senior housing facility, but we continued to see the silver tsunami crash upon our shores. So now we're in a place where we see demand is really has essentially recovered for senior housing, but we haven't seen a lot of new supply come online, and that market's been doing quite well for the owners. And I think one of the things I think is interesting is that we may see echoes of that in some other property sectors, as we've seen construction starts really slow down and in some cases stop in a number of property sectors with a higher rate environment.
And John, just to build on that, I would absolutely echo the benefit of, for years, we saw much higher supply in senior housing, and for us, that was a big issue for a long time. Fundamentally, John, you absolutely nailed it in terms of right now we think about, friends, relatives, relatives of friends who are, finding and seeking opportunities to move into senior housing, and some are finding waiting lists, and it's getting more difficult. And so that benefits the owners of well-located senior housing, where occupancies continue to move up. It's leading to, a strong base of wonderful residents that helps drive effectively higher net operating income, which fundamentally stands out versus other property types in terms of its ongoing strength, and the lack of new supply that, we see there for a period of time should give it great legs. From a fundamental perspective, where we see, limited supply, very strong demand, arguably secular as well, is certainly on the data center front. And if one has, well-located property with power availability, as I mentioned before, it's so critical to make sure one is the pulse on the ability to lock in and deliver power for that data center. These are among the greatest forces. We mentioned other sectors earlier, Mike, that where we do see, and John's echoing it, we see supply waning, and that will add to additional strength just as we've seen to the benefit of senior housing and in data centers. So rather than, let's say, talk up our book, on large overweights or large underweights, I would reiterate the point that, we strive to drive our alpha 2/3 plus of our security, 2/3 plus of our alpha over time has been driven by security selection, whether looking at our global strategies, our U.S. strategies, and this is going back, 5, 10, 15 plus years. And so we're going to continue to do that on our team. And I want to thank you both for having me, with you today in a window where we find it here at Duff Phelps a much more compelling and fortuitous window to talk about it, given the 120 bip move we've seen in the 10-year to go that much higher, and given the pressure we've seen in the prices of publicly traded REITs, particularly with the December pullback and that added cushion, the Fed has given itself. Much like we may see certain companies in their guidance give themselves a little extra cushion as well. So, watch your pencils, and there might be some opportunities if you see that price action.
Well put. Our time is up. John Worth of Nareit and Geoffrey Dybas, Duff and Phelps, thank you for sharing your data and insights. And to our audience members, we thank you, as always, for your attendance and participation. We got to most of your questions, not all of them, but please be apprised that the next REIT IREI Nareit webinar is scheduled for April. We don't have a specific date yet, but keep an eye out for the publicity and registration information on that one. And we hope to see you there. With that, on behalf of IREI and Real Assets Advisor Magazine, this is Mike Consol wishing you all a good day and a great first quarter 2025.